Index funds, mutual funds, hedge funds, ETF? Which one builds wealth and which one quietly bleeds you dry? Did you know most investors pick the wrong fund and lose years of growth without even knowing it? Stay with me, because in this video, I'll show you exact difference between this funds and tell what fund should you choose. Let's start. 1. Index funds. Index funds don't chase stars. They mirror the market itself. They track benchmarks like the S&P 500, a powerhouse list of America's top 500 companies, weighted by giants like Apple and Microsoft. No guesswork, just passive replication. Over the past decade, the S&P 500 has delivered average annual returns around 13%, turning a $10,000 investment into over $35,000 today. Fees are ultra low, often 0.05% or less. That's mere pennies on your dollar. Risks are tempered by diversification. If one company falters, the others buoy you up. So, index funds are about long-term investment with low risk and very low costs. But what if you don't want to wait for so long? If you want high returns but in quick time, then what should you do? Here comes our second fund. 2. Mutual funds. Mutual funds take an active stance. A team of experts hand-pick stocks aiming to outpace benchmarks, potential for outsized gains in niche sectors like tech or emerging markets. Providers like Vanguard and Fidelity offer vast options. It's about making high returns in short time. Average expense ratios hover at 0.65%, which is higher than index funds. But there is a catch. As per Morningstar data, over 80% of active mutual funds underperform indexes over 10 years. Risks amplify with manager errors. One bad call, and your portfolio can dip sharply. But with calculated high-risk bets, you can gain huge returns in short time. So, mutual funds are about taking higher risks to gain more profits in shorter time. Now, what do you think? Where does the ultra-wealthy people invest their money? You may have guessed, mutual funds, because it gives higher returns in short time, right? No. Ultra-wealthy people doesn't invest in mutual funds nor in index funds. There is a very special funds that they use to grow their wealth. So, what is that? 3. Hedge funds. Hedge funds aren't for the faint-hearted. They're exclusive clubs for accredited investors, high net worth folks ready to wager big. Using tactics like short selling, borrowing to amplify bets and derivatives, or complex contracts tied to assets, they chase double-digit gains. In 2025's first half, averages hit 4.83%, but volatility reigns. Some soar over 20%. These funds are famous for making the most returns in the shortest time, but fees are high. Even risks are massive. Leverage magnifies losses, and recent data shows hedge funds increasingly mirror stock market swings, offering less diversification than promised. Fear losing it all in a downturn? It's happened to legends. If markets boom, you could retire as a multi-millionaire overnight. Because who needs sleep when you can watch your fortune fluctuate like a heartbeat? But is there a flexible hybrid that combines the best without the extremes? Here comes our next fund. 4 ETFs. Exchange-traded funds, ETFs, blend index simplicity with stock-like flexibility. Trade them anytime during market hours, locking in real-time prices, unlike mutual or index funds' end-of-day settlements. Low fees, around 0.15% on average, make them irresistible. Track everything from the NASDAQ's tech surge to global bonds. Returns mirror their indexes, often beating active funds long-term. Risks are medium, as intraday volatility can tempt impulsive trades, leading to fear-driven sells and panics. But excitement builds with diversification. One ETF, hundreds of assets. With 2025's market shifts, ETFs let you pivot fast. So after knowing about all these funds, what should you choose? Index and ETFs shine for most. Low-cost, diversified paths to wealth. Ideal for your 20 to 45 journey toward abundance. As Buffett inspires, Don't try to outsmart the market, join it. Mutual funds suit sector bets if you trust the manager, but beware the fees. Hedge funds are reserved for the ultra-wealthy willing to embrace high risks for potential highs. So, now you can choose the fund that's best suits for you. If this ignited your path to wise investing, hit like, subscribe for more insights, and tap the end screen for more videos like this. I will see you there. Till then, bye-bye.